Most recognize EV charging as an infrastructure investment, not just a technology investment. Obviously, location quality and utilization are the ultimate determinants of a site's overall value. In today's episode of Field Frequency, I sit down with Gideon Pfeffer of Charge Capital. We discuss early growth cycles, why charger count means very little without utilization, how investors evaluate charging assets, and the ever-present realities of consolidation in this industry. If you've ever wondered what separates a viable charging business from an expensive science project, this conversation gets into the economics behind the infrastructure. Let's get into it. Welcome to another episode of Field Frequency. Field Frequency is powered by Field Advantage. Field Advantage is an IT field services company specializing in the maintenance and operation of critical infrastructure, including EV charging networks. Today, I'm very happy to have Gideon Pfeffer with me, co-founder and partner of Charge Capital. How you doing, Gideon?
Jason, I'm doing great. Great to be here.
Yeah, we met at EV Charging Summit and had a few conversations since then. Thought it would make sense to get you on Field Frequency to talk about what you're doing in the space, who Charge Capital is to the e-mobility ecosystem, and just have a good conversation because I think you got some thoughts and some ideas and some experiences to share with the audience, and we're happy to have you on. So I'd like to kick off the conversation with you walking us from your professional journey, what led you to Charge Capital. And then once you tell us about you, I'd like you to tell us about Charge Capital. What's the Charge Capital story? What problem is the firm solving in the EV infrastructure ecosystem today? So
yeah, I'll tell you what, I'd be grateful to be able to share a little bit about myself and then Charge Capital. So I am and have been for the majority of my career, over 20 years, I've been a commercial real estate investor, and probably just under 3 years ago, got curious around the energy space and started what I would call my energy journey. But I think probably most importantly, I'm a husband, I'm a father. I try to contribute to my community. Connection to friends and family are super important to me, and so my wife and I just celebrated 20 years and our 20-year anniversary. This past Thursday, my wife, Jamie, who's also my partner in Charge Capital and the managing partner. And for the last 20 plus years, I've been in private equity real estate, organizing capital and investing our own into primarily residential investments. I'm the CEO and managing partner of a company called the GSH Group, and we've got about 5,000 apartment units across 6 states. At one point, we had about 8,000, sold some. And before that, coming out of the foreclosure and financial crisis in 2008, I was what I call a high volume single family aggregator. So I bought hundreds of properties at a time and fixed them up, put renters in, and then packaged them up and sold them to larger capital, institutional capital, and other high net worth investors. And so I've always worked with investors. I've always worked on cash flowing assets, and real estate's been a bit sluggish. Commercial real estate has been a bit of a slog over the last 3 years. 2022 interest rates went up by 5% and turned the commercial real estate market kind of upside down. And so we've been playing a defense in our real estate portfolio for quite some time. And me as an entrepreneur, needed to keep things fresh. And a great friend of mine was playing in the energy space with battery energy storage systems, developing small non-utility grade battery energy, non-battery installations. Let me say that over. Developing non-utility battery installations, smaller stuff, 5 megawatts and smaller, and said, hey, you should take a look at what's going on over here. And he's also a pretty prominent person in the commercial real estate space. And my eyes were open. I see the energy space as when I say space, I mean, industry, ecosystem, place to get involved in from a, occupational perspective or investment perspective. The energy space I think it's the best place to be focused and investing in right now. And it's hiding in plain sight for a lot of people. So 3 years ago, I started getting curious around energy and came to see that there's a disconnect in the smaller mid-market and smaller development space where there's a lot of money, there's a lot of equity, there's a lot of debt available for energy development and installations on a utility scale, on a really big level. But for those who are playing in that, what I call middle market or smaller space, energy development projects that maybe cost $20 million or less, it's a little bit harder at times to secure financing, especially, in that, like, call it $1 to $5 million range. And I think that a lot of EV CPOs and, smaller scale energy developers, EPCs who, have been doing a lot of installations for other developers and are now, getting involved in their own and have good access to good opportunities, but maybe haven't, played with organized capital up until this point. There's a need for a capital market solution in that space. Capital markets meaning debt, equity, and access to both. And so having raised over, $500 million of equity in my, real estate career and bought over $1 billion of real estate, of real estate projects, I thought that I could probably try and help solve that problem. And so my wife, Jamie, and I created Charge Capital to do that.
And so Charge Capital has been 3 years in the market space now?
Charge Capital has probably been around for about 2 years now. Yeah.
2 years. Okay. So either way, a year in e-mobility counts for 3, I think. So
right on.
If you want to count that for 6 years, be my guest. It's a lot that happens in this space in a short period of time, and wanted to get your comments around separating infrastructure from hype. And by that, I mean, a few years ago, and we've seen it even probably now, definitely, COVID era, post-COVID era, capital's flooding into the EV charging space. The sector was viewed as like guaranteed growth trade. There was all these buzz, SPACs were happening left and right. Today, the tone has become more about discipline, more about cost containment, more about profitability, more about sustainability. And by sustainability, I don't mean green. I mean a sustainable business model that will carry them, further than where they're at right now. And so what do you think, based on your experience and, when this in the commercial space, your background, where do you think the market, and again, this is reflecting on what it looked like maybe 2 years ago when you first jumped in versus today. What do you think that the market misunderstood about EV infrastructure economics?
Like I said, I started my energy journey and understanding, a few years ago. So, I would say that I'm still somewhat, well, I'll say I'm greener than some, right, in the space.
No pun intended.
Yeah, exactly. No pun intended. I think that from my observations, there was a lot of, like you said, there was a lot of hype and a lot of money getting thrown around for EV. I'm surprised that at the number of like venture capital groups that are probably more technology based, that threw money at infrastructure. What I would consider EV charging an infrastructure investment,
Sure.
Even if there's a software component to it. But having said that, so a lot of money was thrown at it, and I don't think an overwhelming amount of diligence was put into utilization, and the reality of, EV adoption, traffic count at specific locations, and how much revenue was realistic in terms of, going to be able to be generated at specific sites. Coming from a commercial real estate background, this is very much a real estate play. It's location, location, location.
Mm-hmm.
And you can have best intentions of installing a nationwide network or a regional network. And I think there's like a build, if we build it, they will come mentality.
Mm-hmm.
But if you don't get granular on a site per site basis and make sure that each individual site can stand on its own as its own unique investment vehicle, then, you are susceptible to market forces like, the tax credits going away, EV credits going away. And I mean, we've seen that in the space. I think it's a combination between, maybe not the I don't want to say the discipline, but maybe the understanding of the concept of granularity from site per site. EV networks were set up as like kind of a conglomeration of just, if we just throw a bunch out there, then people will charge, and that the proliferation of EV sales was just going to continue to grow. Just like I said that the commercial real estate has been sluggish because, external factors caused interest rates to go up by 500 basis points, which turned values upside down. If we're relying heavily on the success of a business model based on the federal government continuing to pump out incentives for EV car auto manufacturers and EV charging networks, we could have a hiccup when an administration changes, and that's what we saw.
Mm-hmm. Absolutely. When you're looking at a site, you've been in this space. You talked about leveraging debt, leveraging assets, and really the questions around asset performance that I've got for you is a lot of times when people are talking about the viability of a site or sites, and this was especially the case 8 years ago, 10 years ago, putting chargers in where the power was available, putting chargers in where there was the least amount of barriers, putting chargers in where the utility may have some kind of program stood up to facilitate that, or an AHJ that's already seen chargers deployed. It's kind of like putting it where it's easy versus putting it where it's going to be successful. And again, this is tying into the, asset performance. So sites get kind of in the weeds around charger count, charger output, et cetera. But when you look at asset performance from your perspective, what makes a charging deployment, whether it's a deployment of 10 chargers or deployment of multiple sites, multiple chargers, what makes a charging deployment financially viable? What are you looking for to ascertain its value or viability?
Yeah. And I think that I look at it the same way that most capital does, or from my perspective should. And again, I don't know if my perspective is unique coming from commercial real estate, like I keep saying, but it's all about revenue and validating revenue and expenses, right? So what makes a charging location viable is the reality of the viability of how much net income I'm going to generate off of that one site as compared to what my investment is in the site. So saying it a little bit of a different way, how much of an investment am I making in creating this EV charging site location? What's the dollar amount it's going to cost me completely? And then, how much net income am I going to pull on an annual basis, right? And comparing that net income to my out-of-pocket investment, is that return something that's interesting enough for me or, my investor base or investor partners to want to get involved in, right? There's other factors at play that I think make EV charging installations potentially very unique and valuable, but also more challenging to get financing for. And that's the fact that if you're not working with some sort of a, contracted takeoff, if it's not a fleet, right? Or some sort of a company that, where you're installing chargers at their headquarters. If you're just picking a site out, wherever, and you're relying on, consumers to, pull over and plug in and pay you, it's a speculative investment, really. And so while there's plenty of ways to forecast how much utilization there should be in that location, it's still a greater risk. And so there's, when investments are perceived more risky, that means that the return on that investment needs to go up, which means that the money becomes more expensive and maybe harder to find. So harder to find debt, harder to find, equity that's willing to invest at all. And if they are, it's, they probably want a solid piece of that installation. And, until you can get up and running and have, proof of concept and proof of cash flow at these sites, money's pretty expensive for EV charging installations.
That's right. And muddying the waters have been incentives that were anchored to concepts around where chargers could go. And by that, I mean, deploying funds for, public funds to deploy chargers in a particular area that maybe EV drivers don't live and don't want to charge. And so it's kind of counterintuitive. And so trying to work through, it's kind of like proof of concept. What's it look like now in terms of performance and what's the upside? And without data to support that, I know if I was an asset manager looking to deploy, chargers across multiple sites, I wouldn't be doing that in any kind of speculative way. I'd be looking to leverage software that talks about more, data points and software that talks about more than just, registered EVs in a county or pass through. And gas stations know where to deploy. They know where to input. You go outside of a major town of any size, smaller, whatever, 40 miles out, 30 to 40 miles out, you're going to find a gas station. All over the town, the city, you're going to find gas. They know where to put them. It's got obviously history behind that. But when you look at the future of the CPO model and not only where they're deploying, but what costs they want to bear. The CPOs some want to try to own everything end to end. They want to be vertically integrated. They want to develop their own hardware. They want their software that's designed for their customer. They want, to process the payments. They want to do it all, everything end to end, that full vertical integration, while others are becoming asset light and partner driven. And so when you look at those two models and you compare them, what operating models, or which operating models do you think are going to be the ones to survive over the next 3 to 5 years? Is it partnership driven and asset light, or is it CPOs just trying to be all things to all people and do everything?
Well, when you say asset light, what do you mean? You mean like not owning the actual,
not trying to manufacture their own hardware, whether they're doing it themselves or through an ODM partner where they give a spec. And they're in asset light, I mean, maybe they're operating, they're getting easement onto a site, and they're operating on someone else's real estate versus trying to own the green space as well and build a site and operate there. So I'm talking about kind of the various options within the CPO model. There's some that, they want to own the land, they want to own the software and the hardware and the whole stack, and just, build these hubs. I mean, hubs that
I think that what I see is that this space is pretty ripe for consolidation. I see a lot of similarities, and just I only have my own experiences to go off of, right? And my experiences are probably going to be much different than other folks who have been in this infrastructure space or software space for a long time. But this feels very much like the single family market that I played in between 2008 and 2015. And, in the beginning, and I kind of get this vibe when I'm at conferences right now. And don't get me wrong, like I know this space is not new. There's been EVs for a long time, but we're still in this kind of place where, it's a small community. People kind of are either know or are aware of, who the players are and have seen each other and are comfortable with one another, and are also very open to collaboration because everyone is trying to figure it out just like everybody else, right? And try and leveraging each other, or trying to leverage each other to I saw the same thing in single family. I early on, I was, I'd be at a conference, I'd be with Goldman Sachs, I'd be with, this other operator and that other operator and Blackstone. And, Blackstone didn't have Invitation Homes yet, which is like their division for owning houses. And we're all collaborating, just trying to like figure out what the space was, knowing that there was opportunity, but having it be capital constrained and debt constrained because it was an unproven kind of immature market space. It's not like that today, right? In single family homes as investments are very prevalent now, fast forwarding, almost 20 years. But back then it wasn't. And what happened was there were big players that came to the market who were buying up inventory. And again, it might sound crazy, but to me, it's really not, because, I was buying houses back then for $50,000, $60,000 and renovating and being in for less than $100,000. I mean, that's actually less dollars than it costs to do a decent, EV charging installation right now. Right. So we were able to do high volumes and package them up and sell them to these larger investment groups. And then there was consolidation where the big boys, the big players would then buy the other institutional group. This institutional group had 5,000 homes or 10,000 homes or 50,000 homes, and they would get bought up and rolled up by the larger groups until there was maybe 2 or 3. Right. And that's, I believe that's where this place is going, right? So you're going to end up with where we have today. You've got in real estate, single family, you've got mom and pop investors and owners who own, I'm terribly overgeneralizing, but let's say 1 house to 100 houses, right? Mm-hmm. And then you've got gigantic folks who own thousands of them, right? And so I think that we're already starting to see that in the EV charging space, And so I think that if I'm a charge point operator today, I want to do the best I can to secure the best, most well located, best utilized locations, and either, build up as much as I can while there's still incentives, and then decide Do I want to then refinance into long-term debt and just hold and operate, or, sell, exit, right? And move on to the next opportunity. I don't know if I answered your question necessarily about, I think I went on a bit of a tangent, but that's where I see the space right now. I'm sorry, I'm blanking out on what the specific question was that you asked.
You did well. It's aligned. The commentary is aligned with where the thought originated, and that was where I was talking about the models of the CPO and the
right. It
ownership
should be
models.
asset light or whatever.
Yeah.
I mean, I'm not aware of an over. I mean, again, my knowledge is limited, but I found the model to create the most bandwidth and traction is not ownership of the asset of the land. It's entering into some sort of a long-term lease with a site holder and paying them some rent or some sort of a profit participation, right? It's for the sites that we're involved in, the location isn't the issue, because if you talk to any real estate person and you explain to them that you can give them more money for, land or part of their property that, wasn't generating any income, it's usually a pretty easy conversation. So I guess it's about, quantity or quality, or if you've got an operation that can do both, right? And where you can have both quantity and quality sites. I'm also not super aware of a ton of CPOs that are trying to manufacture their own hardware. Like, to me, vertical integration for CPO needs to be maybe doing their own. Maybe they have some sort of a software for, efficiency or credit card processing, but like there are plenty of groups out there with much better software that I could come up with, who probably would be willing to do some sort of a fee share with me if I give them enough sites, or a discount if they're my own sites. So I try to stay with what I'm good at when I'm owning my own inventory. I think that doing the development, maybe earning some fees on construction or development along the way, and then, figuring out a way to own the sites and the cash flow long term, or, the profit on the exit, makes the most sense to me for the group who looks like an EPC group, or, a small energy developer, right? On the software side, I'm not really in that space. I don't invest in that space. So I could give, conjecture and opinion, but I might sound stupid.
No, fair enough, and that's a level of granularity that I could see where you wouldn't be getting into the weeds on the type of hardware, et cetera. And to respond to the comment about who is really vertically integrated, some of the legacy CPOs, the ChargePoints, the Blinks of the world, they stood up an entire business where they were manufactured, whether through an ODM or internally in house, and their spec, their design. And maybe others were assembling, or maybe there was a portion of assembling or final assembling happening in-house, et cetera. Sure. So there's different models out there, but really, this commentary is kind of almost transferable from various different types of industries, because you see commoditization versus a durable advantage, and how do you get there? What brings that durability? The market, our charging market, has no shortage of hardware. Like you said, why would I try to develop my own software when there's probably some pros out there that already have some products, and others are seeing exactly what you're saying there. And so the market has no shortage of hardware, no shortage of software platforms. There's plenty of there. And to your earlier comments about consolidation, those that are doing what they're doing really well, they will survive. Those that aren't will get absorbed, so on. So that speaks to that piece. But when you look at the commoditization in the product side, where do you see defensible differentiation for the operator, or whoever who you're supporting? How do you get them to try to think about differentiating? Is it on the operational side? Is it on market intelligence? Is it the structure of their deal to begin with? How do you try to create those deals or curate those deals for your clients?
That's a good question, and I want to say that, those who get, in a world of, or a future of consolidation, where there's consolidators and consolidatees, those who get consolidated, meaning, bought up, doesn't necessarily mean that they didn't do a good job. Right?
Sure.
Exiting is a great strategy. Taking chips off the table and figuring out what's next, or just, the idea of that everything is always for sale, it's just at the right price, and there's probably always going to be somebody bigger than me and my operation who can operate a little bit more efficiently than I can or really want to, right? And they think they could make more money than I'm making, let them have a shot. Somebody, one of my mentors said to me, don't love something that's not going to love you back, right? And that context was a multifamily apartment building, right? But like a portfolio of EV charging stations, it's not going to love me back, right? So I try. A long time ago, I learned to not like put my identity on or in how many X I have or how many X that I built, right? It's a good track record. And if I exit and put some money in my pocket, I can do it all over again, in the same industry or maybe something different. And because again, you don't know what market factors are at play. And unless I'm like one of those really large groups that, is independently funded or they're wealthy or funded. If I can be affected by external market factors, like if I've had a good run, maybe it's time to cash in at a certain point. So I'm always thinking about an exit.
I think your commentary is aligned with where the thought trajectory I'm sending you on, and
Yep.
It's there. And like you said, it's not necessarily those that are acquired failed. It's if they were acquired, there was some value to the acquisition to begin with.
Right.
Of course, there's insolvency and there's
it happens,
debt acquisition, and there's all of that. And some of the market tells you either today or tomorrow, or maybe the day after that, who the winner, who the loser is.
Mm-hmm.
That's just the nature of it. But no, I was asking about differentiation, and I guess when you talk, we're Field Advantage. This show is powered by Field Advantage. We're about field services, operations and maintenance, reliability, uptime for the operator.
Yep.
When you are talking to clients or prospective, clients, when you look at reliability as an investment variable, in other words, okay, we're going to get the site built, we're going to get it out there, however that looks like, whatever that looks like, it's out there. Do you think investors or prospective investors are considering the uptime and operational reliability of the site as maybe just it's an operations issue, or do you look at that as a core financial performance metric? What is your view around that? And the reason why I'm asking about that is because it's I'm kind of leading the witness here. You might say, because it's like the investor is going to think about deployment and obviously is looking for ROI, whatever that roadway looks like, or ramp up looks like. But when you talk about the operations, the reliability of the site, is it usable? Is it a successful charging site? I would think that a financial performance metric of that investment would be, how are we going to protect this site and make sure it's accessible to those that are trying to use it?
100%. I mean, I had to learn a lot. I said earlier, Charge Capital has been around for 2 years. I've been in this energy space for 3. And, we didn't actually start doing our first project or deploying capital until about a year ago. Right. Mm-hmm. And so that was 2 years for us to do our best to learn everything about everything and learn a new language, because it is, there's a lot of acronyms in this space, and, you have to be okay saying, I don't understand what that is. What is that?
Sure.
And as a capital market solution, as a fiduciary to investors and deploying capital on behalf of investors and debt groups, I have to know that, a project that has this grant or this rebate, does it have what's the catch, right? Okay. You have to be at 98% uptime or 97% or 95% uptime. How are we going to ensure that? Right. And what's the cost? Right? What's the cost? Is it, hopefully it's covered in the first 5 years, but after that, then what happens? And if you are an operator that's vertically integrated and doing all of your own installations and doing all of your O&M, like, are you uniquely qualified to be doing that, or do you just think you can? Right? And there is a very specific amount of granularity that's required to make sure that everything that's in a pro forma or being portrayed as how well this site or group of sites or portfolio can perform, that it actually can. Like it's like trust but verify. Like I like people and I believe them, and I believe that they believe themselves as well. The question is there actual proof and validation behind, the revenue, the cost of energy, the cost of operations. What happens if things go wrong? Do you have the proper insurance? Do you have the proper coverage? Are we all going to be covered appropriately? Like every line item in that pro forma is checked and validated, or money isn't deployed.
Absolutely. When you are looking at, between today and 2030 for charge capital, and obviously you're going to be looking for what the market is signaling, what story is being told, what's real. Like you said, as you're trusting but verifying, you're letting the pro forma stand up the viability of the site. It's beyond the aspirations of who you're talking to. It's got to go beyond that, and there's got to be some substance to there. There is today obviously a disconnect between EV adoption headlines and real world utilization, real world success. It's just like every time an EV catches fire, we hear about it, despite that's 1% of the amount of vehicle fires and passenger, light duty vehicles every year, according to AAA. I mean, it's like 2,300 cars catch on fire that are powered by gas or diesel during the year, and maybe 1% of that corresponds to what an EV catches on fire.
By the way,
but we hear
what you're saying is true.
It.
I had my insurance consultant. We put level 2s we're putting level 2s at a bunch of our apartment communities, and I wanted to validate that it wasn't going to affect our insurance premiums. And it's true. Like all you hear about is that 1,700 EVs caught on fire over the last 5 years or something like that. But then and the insurance consultant said that, and I said, well, how many regular cars did, right? And they were like, 180,000 or something like that, right? So like legitimately 1% of EVs are catching fire, but that's all you hear about.
Yeah, and that's kind of my commentary there was on the disconnect between headlines and real world utilization. I mean, another example is an operator was catching flack from the AHJ about putting some chargers in a parking garage because of the risk of a EV fire, and it was like the counter was like, well, in this same parking garage where these 4 EVs will park, there's 300 other spaces filled with vehicles with gasoline inside of the tanks, and that's a combustible fluid. What's the difference here? You know, it's like if a gasoline car catches on fire in a parking garage and creates a chain effect, that's going to be a bigger issue than an arc flash event at the charger inside the parking garage, and we're freaking out over putting these chargers in there. And the whole basis for even these comments that I'm making is about the difference in headlines versus real world stats. And so, going back to my question, when you're thinking about charge capital's runway between today and 2030, what are the demand signals that you are going to trust or that you are going to lean on to evaluate an infrastructure investment? You're not going to let the headlines do your thinking for you. You're not going to let, the EV evangelist do your thinking for you. But what are your demand signals that you're going to be trusting as you evaluate where to direct capital or where to leverage it?
So as it relates specifically to EV, because we're very invested and will continue to invest in, excuse me, we're very invested and will continue to invest in battery energy storage systems, which is really the new solar.
Ecosystem.
It's what's happened. It's it's the only part of the ecosystem that still has ITC, and there is a tremendous supply demand imbalance and transmission issue in the United States. It's actually what got me into EV, because we often will pair EV with battery to get the load that you need for, to qualify for the demand response programs for different states, or, perhaps it's just the best way for arbitrage, But as it relates to the EV investments that we'll continue to make, and we will continue to make them, we're probably more focused in locations and regions where adoption is high, and that there is a density and conglomeration of EV users and EV users maybe that don't. And there's also, let me say it a different way. There's a high concentration of EV users, as well as a high concentration of non-homeowners and renters. We like those spaces. We like density, and coupled with, the inability to put a level 2 in your own home, right? Where are locations where there's a better probability than for people to have to go out and charge outside of their house on their way to work or whatnot. We start with that real dense population, and then you overlay incentives as they are still available. And that'll probably satisfy the majority of, the capital that we're going to have to deploy. And we have quite a bit of it. We also act as, a bird dog, or if you will, where we're just like I did in my single family real estate days. We are actively acquiring sites, partnering with other charge point operators, for those of you listening, and providing the capital to create portfolios of EV charging, and then selling them to larger companies that want to own this type of infrastructure, or have a allocation of funds that they need to deploy into the energy infrastructure space. So we have those contacts and the resources to execute on that. And there is quite a bit of interest from large infrastructure investment groups. And so there is an opportunity for Charge Capital to partner with other CPOs and energy developers who are in the space, who have access to portfolios, who have access to sites or infrastructure. So we are actively seeking those types of relationships.
Right. Well, to that end, we are rounding the corner on this conversation. To that end, how would someone reach out to you and connect with you, Gideon? How would they find out more about what Charge Capital is doing? How would they connect with you with the various suggestions you just made? What's the best way to reach out to you?
Yeah, for sure. So you can send me an email, gideon@charge-capital.com. You can email info@charge-capital.com. Or if you don't hear back from me, you can also reach out to my head of investor relations, Nick Small, at Nick, N-I-C-K, at charge-capital.com. Check us out on our website, or you can also see me on LinkedIn. Connect with us on LinkedIn, send us a message, and we'll see if there's a fit.
Sounds good. Gideon, thanks for coming on Field Frequency. It was a pleasure to have you.
Yeah, my pleasure too. Thank you so much.
This episode was produced and edited by the team at Autozy. To find out more, visit autozy.co, AUTOZY.co.